Hello everyone. In this video I'm going to talk about how to record basic accounting transactions. Okay, so we've already discussed this in a previous video. We said that the basic accounting equation is assets equals liabilities plus owner's equity. Now the assets are the resources owned and under the control of the business, and these includes cash and accounts receivable. This is the money that your customers owe you. Short-term investments and long-term investments in stocks and bonds of other firms held for the short-term or the long-term. Different kinds of inventory, such as finished goods inventory, work in process, raw materials, and prepaid expenses, something like prepaid insurance expenses. This is money you have already paid, but you haven't consumed because you haven't received the services from the suppliers you paid this money to. And then your fixed assets, property, plant, and equipment, and your intangible assets, such as goodwill, trademarks, and so on. Okay, these must equal the liabilities and owner's equity. So anything that is controlled by the business, or let's say the sum of the values of all the assets under the control of the business, must equal the sum of the commitments the business has towards owners and non-owners. Okay, so the business owes money to its suppliers, that's accounts payable, and some of the customers too, who have paid in advance but haven't received any goods or services. So this is unearned revenue. And the company also owes money to its employees, that's salaries payable, to creditors, that's short-term payable, interest payable, and long-term debt. And it owes money to its owners, that's capital and retained earnings, depending on the sources of the money. Either the money that the company owes to its customers, to its owners, has either been contributed directly by these people, by the owners, and that's classified as capital, or has been accumulated over time as profits, undistributed profits. It's still owed to the owners, but it's classified under retained earnings. Okay, we'll simplify this into cash, accounts receivable, inventory, prepaid expenses, property, plant, and equipment. And on liabilities and owners' equity side, accounts payable, salaries payable, long-term debt, capital, and retained earnings. So we're going to take an example that we'll run through to show how transactions are recorded. We'll assume that the business starts work at the beginning of the year with 0 assets and 0 liabilities. And we will track the financial position of the firm as it goes through the different transactions. What are these transactions? We're going to assume the following transactions. January 1st, owner starts business by investing $120,000 in cash from his or her own savings. Same day, firm buys a small store for cash of $45,000. Okay, obviously this is fixed assets and it's needed to start business. Then the company pays insurance in advance of $12,000 covering 1 year. And we'll see what happens, how this is recorded and what happens at the end of each month. Firm buys store equipment for $10,000 for cash. And then firm buys merchandise inventory for $15,000. So this is inventory that the business plans to resell. And the cost for the business is $15,000 and it's paid in cash. Then it buys more merchandise inventory, this time worth $10,000, but it doesn't pay. It buys it on account. Okay, then firm sells goods that cost $1,000 for $1,400. So that gives it a profit of, on this transaction, of $400. We will see how this is accounted for, both the costs and the revenue. Okay, next slide. Firm sells goods that cost $2,000 for $2,800, this time in cash. Here, in the first previous transaction, it sold it on account, so it didn't receive money. Here, it actually received the money right when it delivered the goods. Okay, firm incurs insurance expense for the month. That's what I alluded to earlier. We'll see how this is accounted for. The prepaid insurance expense of $12,000 for the whole year. Firm takes out a long-term loan of $2,000. Now here we're January 31st, end of the month, right? These two transactions and the rest of the transactions are occurring at the end of the month. Firm incurs salaries. So the company prepares its payroll, and it figures that it owes its employees $800. It doesn't pay yet. But it still has to accrue these salaries so that its profit or loss figure is takes into account all the revenues and expenses for the month. Firm collects cash of $1,000 from the credit sale, the sales transaction 7. Okay, firm accrues depreciation expense on its property, plant, and equipment of $300 for the month. Sorry, here this is misspelled, CIA. Okay. Owner makes a personal withdrawal of $3,000. Now here depreciation expense is needed again to match revenues and expenses. So the firm has to make an allowance for the depreciation in value or the consumption of its fixed assets in the process of providing services. So it needs to have some number to show. It's not like these assets are for free. So it takes a charge for the benefit of the usage of these fixed assets. And here, this is a kind of disinvestment by the owner. The owner takes out $3,000. We'll see that this is not really an expense of the firm, but it's a reduction of owner's equity. Okay, so these are the transactions we're going to cover. Let's start with the first transaction. Now remember, assets was 0, liabilities and owner's equity was 0 right before this first transaction. First transaction, owner starts business by investing $120,000 in cash from own savings. This happens January 1st, transaction 1. Okay, so we analyze this transaction. Assets of the firm increased in the form of cash, $120,000. And the firm needs to be aware of this and record it. And at the same time, it needs to know what happened on the other side, if anything. The effect might, the opposite effect might be within asset itself. We'll see this in a minute. But in this case, the offsetting amount that will keep the accounting equation balanced, that will keep assets equal liabilities plus owner's equity, is an increase in capital of $120,000. So cash increased, capital increased, assets still equals liabilities plus owner's equity. So this is the effect of the first transaction. So we analyze the transaction of its in terms of its effects on different assets and different liabilities, and we make sure that the accounting equation stays correct, stays balanced. Next transaction, firm buys a small store for cash of $45,000. Now, the firm has paid cash in this case, $45,000, so this has to be deducted from the cash amount. Right before this transaction, it had $120,000 minus $45,000 cash. Now it has $75,000 cash. Capital hasn't been affected. Nothing on this side has been affected. Think about it. Right? What happened is that now the firm has a fixed asset, and that is classified as property, plant, and equipment. This increases by $45,000. As a result of this, cash $75,000, property, plant, and equipment $45,000, assets still $120,000, liabilities and owner's equity $120,000. The equation is still balanced. What this tells you, the current financial position of the firm has cash and has fixed assets, and the value of all of this is owed by the firm, is owed by the firm to the owners as capital. Okay, the owner contributed $120,000 as cash. Some of that was changed by the firm into a fixed asset, but it's still the value, the sum of the value of the cash and the PP&E are still owed by the firm to the owner as capital. Transaction 3. Firm pays insurance in advance of $12,000 covering 1 year. Okay, so again, we're assuming that this was paid in cash. So cash decreases by $12,000. Okay. Now, the firm hasn't received any insurance services yet. It just paid the money. That money, theoretically, is still the company's money, right? If the insurance company goes bankrupt, right after receiving that money, it has to pay that money back. As far as the firm is concerned, that money is an asset, and it's recorded as a prepaid expense of $12,000. Assets still equal liabilities and owner's equity. So you should have noted by now that a transaction could either increase assets, increase liabilities, or owner's equity. That would keep the accounting equation balanced. Or we might see one asset increasing and another asset decreasing, as in this case, right? In this case, cash decreased, another asset increased by the same amount, offsetting the decrease in the first asset and keeping the balance in the accounting equation. Transaction 4, firm buys store equipment for $10,000 for cash. Pretty similar to the previous transaction. Cash was paid out of $10,000, leaving us with $53,000 of cash. And this is equipment, so it's properly classified as PP&E, and it's added to the value of the store that we just bought, bringing our PP&E to $55,000 plus cash of $53,000. Again, we also have $12,000 in prepaid expenses. Total assets is still $120,000, and all of that is owed to the owners as capital. So what's happening is still the business is just managing its assets and redistributing the cash to other more productive assets while keeping its liabilities, sole liability, to the owners as capital. Next, transaction 5. Firm buys merchandise inventory for $15,000 for cash. Obviously, it needs inventory to start selling. Again, it paid in cash. Cash goes down by $15,000. This time, inventory increases by $15,000. Everything else is still the same. One asset decreased, another increased by the same amount. The accounting equation still holds. And now the firm is better prepared to start business. It has property, plant, equipment, store and equipment, inventory, cash in case it needs that, right? And has prepaid some expenses. It's insured, so it can start making some money maybe. But first, actually, in this transaction, firm decides to buy some more merchandise inventory. This time, it buys it on account. Okay? It buys inventory worth $10,000. It doesn't pay any cash, so the cash balance would not change in this case. Certainly, inventory would increase by the $10,000 cost of the inventory it bought. The inventory amount holds the cost of the inventory on hand, right? In this case, to keep the accounting equation balanced, we actually decide to increase accounts payable. After all, accounts payable records the liability of the firm towards its suppliers. Okay, and that's $10,000. Assets increased in terms of inventory, $10,000. Liabilities, accounts payable increased $10,000. Now the assets of the firm are worth $130,000. And the liabilities have a book value of $130,000. The accounting equation is still balanced, and we successfully account for this transaction based on its effect on the different accounts of the firm. Okay, in this seventh transaction, the firm sells goods that cost $1,000 for $1,400, and it's on account, so the firm doesn't receive any cash. Okay, now in this transaction, we have two elements that we need to account for. First of all, we need to account for the fact that the company gave up stock for the transaction, and for the fact that it earned money for delivering those goods to the customer. Okay, the first part, which is the inventory part, the company sacrificed $1,000 worth of inventory, so the inventory will decrease by $1,000, leaving the company with $24,000 worth of inventory in terms of cost, of course. Now, giving up inventory results in reduction in owner's equity. Expenses such as this, and this is really cost of goods sold, are incurred on behalf of the owners, and therefore the 1,000 must be deducted from retained earnings. On the other hand, the company earned $1,400 for this transaction. It hasn't received this money, so this money is not added to cash. Instead, it's due from the customers, and therefore it's recorded as accounts receivable, increasing assets by this amount. On the other hand, the owners of the firm earned that money as the company made this sale on their behalf, and therefore retained earnings increase. Again, in the real world, the $1,400 increase is recorded as sales revenue and then closed in retained earnings at the end of the accounting cycle, and the $1,000 decrease is recorded as cost of goods sold and then closed in retained earnings. Okay, so after this transaction, assets increase actually by a net amount of 400, the difference between the increase in accounts receivable and the decrease in inventory, and at the same time owner's equity increases by $400. Transaction number 8. In this transaction, the firm sells goods that cost $2,000 for $2,800 in cash this time. So the only difference really, there are two differences, the amounts of course, and the fact that the company in this case received cash for this transaction. So again, inventory will decrease by the cost of the stock given up to earn revenue, sales revenue for this transaction. The decrease is $2,000. So inventory is down by $2,000. At the same time, retained earnings is down by $2,000 as cost of goods sold. The company, in addition, receives $2,800, increasing cash by $2,800. And this is revenue, sales revenue, that will ultimately increase retained earnings, which is a component of owner's equity. Okay, and again, the net effect of this transaction on assets and liabilities plus owner's equity, assets increase by the difference, which is 800, and owner's equity increases by the same amount, by the same net amount, which is $800. So this is transaction number 8. Transaction number 9, firm incurs insurance expense for the month. Now remember, the company paid $12,000 as insurance for 1 year. At the end of each month, it has to take part of that prepaid insurance and recognize it as an expense. It does this by reducing prepaid expenses, which before that had $12,000 of prepaid insurance expense. It reduces it by $1,000, reducing assets by this amount. Okay, at the same time, it has to record that as a decrease in owner's equity. As the company used its fixed assets that were insured to generate revenue, it incurred expenses. One of these expenses is certainly the insurance expense. Again, the expense, $12,000, was paid in advance for 1 year. At the end of each month, the company will expense part of this asset, in this case $1,000 per month. It will deduct it from its assets, and it will decrease its retained earnings by it, recognizing it as an insurance expense instead of a prepaid expense as it did when it paid the amount. Okay, so this is how we account for prepaid expenses. First, the company recognizes the prepaid expenses as an asset, deducting cash for it and recording it as a prepaid expense asset, and then it kind of amortizes it or expenses it over the period, right, covered by it, little by little. Before the company can produce any financial statements, it has to make this accrual. Transaction number 10. Firm takes out a long-term loan of $2,000. The company actually receives cash from the bank, right? And that increases its cash balance by $20,000. And this is a liability that it owes. And here we're assuming that it's a long-term loan, and therefore it's categorized as a long-term debt, which means that it will be paid in more than 1 year. That's the usual criterion we use. Okay, so assets increase by $20,000 and liabilities increase by $20,000. Transaction 11. Firm incurs salaries of $800. This happens at the end of the first month of the work of the company. Again, before the company can produce any financial statements, it has to make sure it recognizes all its expenses. And one of these expenses is the salaries expense. In this case, the company figures out that it owes its employees $800 for the work they performed during this month, the first month of its operation. It hasn't paid that amount yet, so it doesn't have to reduce cash for it. Instead, it records it as a liability, as a commitment to its employees, increasing salaries payable by $800. Now, this is an expense, so it has to reduce owner's equity. And it's recorded as salaries expense, and then it's deducted from retained earnings. So the net effect of this transaction of recognizing an expense, in this case an unpaid expense, is increasing a liability, salaries payable, and decreasing owner's equity, that is retained earnings. Retained earnings gets the effect of all revenues and expenses. Revenues increase retained earnings and expenses decrease retained earnings. And retained earnings is the owner's share in the value of the assets of the firm as a result of the work of the company and its production of revenues and expenses. So this is transaction 11. Moving on, transaction 12. Again, this happens at the end of the month. In this case, the firm collects cash of $1,000 from the credit sales transaction, transaction number 7. In that transaction, the company sold goods costing $1,000 for $1,400 on account. That amount, the $1,400, at that time increased accounts receivable, not cash because it wasn't collected, increased it by $1,400. As we collect the $1,000 of these $1,400, we need to decrease accounts receivable. Our customer now owes us only $1,400, not $1,400. At the same time, we collected cash, therefore cash increases by $1,000. In this transaction, only asset accounts were affected. Cash increased by the collected amount of $1,000, while accounts receivable decreased by $1,000, leaving assets equal to liabilities, as must always be the case. In transaction number 13, the firm accrues depreciation expense on its property, plant, and equipment of $300 for the month. In this case, the company must consider the fact that it's using property, plant, and equipment, and the value of these fixed assets is either decreasing or, in fact, helping produce revenue. And therefore, to get a reasonable, sustainable net profit figure or net income figure, the company apportions part of that cost, of the cost of its fixed assets, over the useful life of these assets. It takes out a charge against these fixed assets, spread over the useful life of the assets. In this case, the firm figures that it has incurred $300 in terms of depreciation expense. So the company deducts that amount from the book value of its property, plant, and equipment. At the same time, it records the same amount as a decrease in retained earnings. Okay, so again, this is a depreciation expense. Sorry for the misspelled word. This is a depreciation expense. The company reduces property, plant, and equipment's book value by the estimated decline in the value of these fixed assets and charges that against its revenues by deducting that amount as a depreciation expense. Again, after this transaction, assets still equals liabilities plus owner's equity. Now the final transaction, transaction number 14. In this transaction, the owner makes a personal withdrawal of $3,000. So, cash as an asset decreases by $3,000. Now this withdrawal might be considered either a redistribution of retained earnings, a distribution of profits to owners. But since retained earnings in this case is a negative figure, the company actually has no accumulated earnings to distribute to its owners, and therefore we will consider this withdrawal as a reduction in capital. So the owner withdraws $3,000. That reduces cash by $3,000 and reduces owner's equity through capital, in this case by $3,000, leaving assets equal to liabilities and owner's equity. So this is the end of month 1 of the life of this company. So after the last transaction, these numbers give what we call the financial position of the firm. This includes both the accounts in the assets, the numbers in the assets accounts, and the numbers in the liabilities and owner's equity accounts. The firm has ended this month with $61,800 as cash, $400 still owed by its customers, $22,000 as inventory it's holding, $11,000 of prepaid insurance expense, and $54,700 as a net value of its property, plant, and equipment, after writing off $300 of this value as a charge against revenues. On the liabilities side, the firm owes its suppliers $10,000, its employees $800, the bank $20,000, and it owes its owners $117,000 as a capital contribution and minus $900. So actually this must be deducted from the $117,000 to arrive at the net owner's equity. because retained earnings is a negative $900 as a result of the loss that it sustained in the first month. Now these figures are summarized in the following statement. It's called the statement of financial position or the balance sheet, and it shows the same numbers that we arrive at as balances of the different accounts after recording all the transactions. In addition to that, companies present what's called an income statement that shows the revenues and expenses of the firm during the accounting period covered by these statements. In this case, the firm made a sales revenue of $4,200 from 2 sales transactions. To earn this revenue, it had to give up inventory costing $300, so this was recorded as cost of goods sold. In addition, it incurred $800 as salaries for its employees, which, by the way, it hasn't paid yet, but still it has to record it to make the net income or net loss figure more representative of the revenues it earned and the sacrifices it made. Depreciation expense on its property, plant, and equipment was recorded too, and that was estimated at $300. The details of how to arrive at such a number will be covered in later videos. And the company reduced its $12,000 of prepaid insurance expense by $1,000 of insurance benefits that the firm received over this month, leaving it with only $11,000 as an asset in the prepaid expenses account from the same payment of $12,000. As a result of this, the firm sustained a net loss of $900 for the period. This is the end of this video. Thank you very much.